Wall Street closes an earnings-heavy week lower. The Dow Jones snaps a 4-week winning streak. Investors now look ahead to a raft of earnings from tech giants like Alphabet, Amazon and Meta. Stocks in the Asia-Pacific open mixed, while the SGX Nifty indicates a positive start for the Indian market. Crude oil prices slip over 5% for the week as uncertainty over interest rates continues to cloud the outlook on demand. Gold too falls for the week under pressure from a stronger dollar. Reliance delivers a very strong fourth quarter with an all-round beat on estimates. A strong show from the oil to chemical business drives record quarterly profit while margin too expands. And ICICI Bank posts its highest ever interest in the fourth quarter. Quarterly profits hit an all-time high driven by strong interest income growth, while asset quality is at its best level in 33 quarters. The Reserve Bank allows HDFC Bank to raise its stake in insurance subsidiaries to over 50% before the merger with HDFC. This will allow the bank to buy Aberdeen's 2% stake in HDFC Life. Good morning and welcome to Power Breakfast. I'm Pavitra. Those are all of the top headlines that we have for you this morning. So there's clearly lots to track in terms of earnings that have come through in the global market action. So let's kickstart the show by taking a look at what the global markets are doing right now. For Asia, you're not really seeing too much direction at all. It's looking pretty mixed. What's moved, it's absolutely flat. Like you can see, Hang Seng is just around 2 points in the green right now. You have Taiwan trading with a 0.2% gain. But for markets like Straits, Shanghai, Kospi, you're seeing somewhat of a cut come through. So Kospi is perhaps the worst this morning. It's seeing a 0.7% cut. Apart from that, there's really no big direction coming through from the Asian markets. Very flat over there. The SGX Nifty will come up for you. It has moved up a little bit as well in the past few minutes. So right now, it's around 40 points in the green for the SGX Nifty. So perhaps a positive open after the very, very flat close that we got on Friday. Remember, last week as well, we did see cuts for our own market. So we could start this week in the green. But that's what's going on with Asia. Let's talk about the US as well. We had Wall Street and Friday's trading session with just some marginal gains. So the three major indices, like you can see on your screen, ended just around 0.1% higher. The Dow, S&P as well as Nasdaq all, however, finished the week in the red, right? So you had the Dow Jones even snapping its 4-week winning streak. So those are the kind of losses that you saw for this week. In terms of what you have to watch now from Wall Street, you have a lot of tech earnings coming through. Pretty much all of the big ones, so Alphabet, Microsoft, Amazon, Meta, all of these will be declaring results this week, and that'll be important to track. But for now, we have CNBC's Kate, who's standing by with a wrap of all of the action that we saw on Friday.
Markets finishing the day mostly flat. The Dow adding 22 points, the S&P gaining 3, the tech-heavy Nasdaq up 12. Lyft announcing a major round of layoffs as the struggling rideshare giant, which has seen its stock plummet 70% over the past year, struggles to reshore its footing. The move comes a week into new CEO David Risher's tenure. The Wall Street Journal is reporting that at least 1,200 employees will lose their jobs, or around 30% of its workforce. The stock climbing 6% on the announcement. Meanwhile, shares of Procter & Gamble rallying after the consumer goods giant saw its latest earnings beat Wall Street expectations. The company, which makes brands like Tide and Charmin, said higher prices helped to offset lower demand for its products, especially in Europe. That's what's happening here in the U.S. Back to you in Mumbai.
All right, Kate, thanks a lot for getting us all of that action from Wall Street. But staying with the U.S., we also had home good retailer Bed Bath & Beyond, which has now gone ahead and filed for bankruptcy protection and has asked the courts for permission to auction its assets. Remember, all of this comes after several failed attempts to, try and raise enough money to keep the company alive. The retailer had been warning of a potential bankruptcy for a while now, since early this year. And for the time being, we do have the 360 stores in the U.S., which will continue to function as the company works to liquidate its assets. So that's another important piece of news that came through from the U.S. But here's some important commentary as well that we're tracking. This comes in from a host of experts on the inflation trajectory as well as the Fed's policy going forward. Listen in.
I think one and done is most likely, but the uniformity and the fact that inflation is still relatively high, it may leave the possibility of a June hike on the table. I would say one and done much more likely, but not fully baked in just yet. The market, I think, is more optimistic, let's say, about Fed cuts than the Fed themselves. Obviously, the incoming data will show what actually happens, but indeed, inflation is still running well above the 2%. University of Michigan survey of consumer sentiment or expectations for inflation, showed some measures anyway that consumer expectations of inflation have actually risen. So I think the market and the Fed are certainly not in the same place around an expectation of a rate cut this year. Obviously, incoming data we'll have to prove one of those two sides wrong.
5% inflation, 4% inflation, unacceptable. You have to be moving towards the 2% target. That's your job. And at 3.5% unemployment, still more people trying to find people to work than people willing to work, then you have some leeway to run a tight ship. The markets are tightening, and the banks are being more stingy and not lending as much. It's hurting the commercial real estate sector. It's killing venture capital. Anybody that's providing either loans or some kind of credit or investment to these sectors is pulling in their horns. That's helping, but it doesn't seem to be doing too much too quickly here.
We're heading for a slowdown, and depending on who you're listening to, a severe one or a milder one, but the Fed is going to cut hundreds of basis points, and therefore you should own interest rate risk here or duration, lots of duration here. And that, of course, conveniently ignores the fact that inflation is still uncomfortably high. We know that as goes inflation, so goes the correlation between stocks and bonds, meaning when inflation is high, that correlation is positive because the Fed's hands are tied to deliver the kinds of cuts that make bonds really that sort of port in the storm for portfolios. So I think, yes, we could potentially be headed for a stagflationary scenario, and that's not really a narrative that's out there, and I think investors have to contend with it.
All right, that is an important word coming in on the inflation picture right now, as well as how the Fed could perhaps move from here. But this week, remember, like I was telling you, we're looking forward to a bunch of mega earnings coming through from all of the tech names. So the likes of Alphabet, Microsoft, Amazon, and Meta will all post earnings this week. So it's important in those terms. So listen into what Ashwath Damodaran of the NYU Stern School of Business has to say and what he expects from big tech this time around.
If you look at what's happened this year, it's really the large tech, money-making tech that's rescued the market. I mean, collectively, money-making tech, the largest tech companies have added $1.7 trillion in market cap just in this year. Without them, the market would be in trouble. And I think they can sustain the market because there are two things that are happening. One is people are discovering how much pricing power they have. And the other is I think a lot of these companies took 22 as an opportunity to dump all the bad stuff into their earnings. They said it's a bad year, might as well dump stuff. So I wouldn't be surprised if you see a lot of positive surprises coming out of their earnings reports.
All right, that is on the big tech names from the US. But with that, let's also talk about all of the cues that you should track as we get into this fresh trading session and this new week. We have our research team here with the trade setup. Mangalam, Rima, as well as Surbi join me now to take you through everything that you should watch. Guys, a very good morning to all of you. Rima, let me come to you first. We were just going through the global setup, but today could be a lot about the domestic cues, right, with ICICI Bank and Reliance going.
Pavitra, I think this is going to be day one of an extremely busy week in terms of cues, macros, as well as domestic and international in terms of earnings. But the SGX Nifty, as you pointed out earlier, is suggesting a flat start, but with a positive bias. So currently holding up in the green. Asia is a bit mixed, but more on the negative side. No big direction emerging from Wall Street. Wall Street ended absolutely flat. In terms of the two big drivers in today's trade, one is likely to be ICICI Bank, a very impressive set of Q4 numbers. NII growth 40%, PAT jump of 30%. The return ratios have improved. The net interest margin is at record high levels of 4.9%. Reliance Industries, too, has clocked in a beat on expectations. So the net profits have gone up 22% on a quarter-on-quarter basis, aided by a strong performance in the oil to chemicals business. So that was the big driver. And these two stocks command a high weightage on the Nifty, and we could see some, could see us propel the markets higher. That said, there were many other stocks reacting to earnings, and we will talk more about that. But this week, we've got numbers from banking heavyweights like IndusInd Bank, Axis Bank, Kotak Mahindra Bank, also other financial names like Bajaj Finance, Bajaj Finserv, HDFC Asset Management. In the consumer basket, you've got HUL, Nestle, Tata Consumer. In the auto basket, Maruti Suzuki will be reporting numbers along with that Bajaj Auto. IT stocks not to be left behind. Tech Mahindra, Wipro will be reporting numbers. Ultratech Cement. You've got action in the primary markets tomorrow. Mankind Pharma, a very large IPO, will be opening up for its subscription. Last week, it was very lackluster on the benchmark indices. The Nifty traded in a very tight band of about 300 points. Mid-caps fared a tad bit better. In terms of the institutional activity, on Friday, the FIIs sold 2,100 crore in cash. The DIIs net bought 1,632 crore. And remember, this week is also the expiry. So coupled with the big Qs, the news events, and the expiry, we could expect an action-packed week. Back to you.
All right. And remember, all of last week, we were talking about how it's feeling a little bit dull and there's not too much happening. So this week seems like, we're set up for quite the opposite. Rima, thanks a lot for that. But let's also talk about the individual names that we should track in today's trading session. We have Surbhi here with the entire list. Surbhi, lots of big earnings.
Good morning. Quite a few result reactions over the weekend. The first one is, of course, Reliance. Very strong numbers in Q4, a beat on all fronts. Highest ever quarterly profits reported by them, led by strong O2C business. The consolidated profits were up 22% sequentially, and the EBITDA margin came in at 18% versus 16%. Next is ICICI Bank, where the net interest margin is at an all-time high of 5%. The operating profit growth is an 18-quarter high at up 34% on a year-on-year basis and 4% sequentially. Yes Bank, the Q4 numbers were a mixed bag. The asset quality deteriorated while the net interest margin is the best in 9 quarters versus an expectation of a decline over there. Macrotech Developers, the revenue was down 6%, the EBITDA was down nearly 15%, but the net profit was up 39%. Some other companies that may react to their numbers, Tejas Networks and MapMyIndia, so watch out for that as well. Some other companies that may be in focus, Sun Pharma, the company gets a non-compliance letter from US FDA for its Mohali facility. And lastly, HDFC Bank, where RBI allows HDFC Bank to hike stake in HDFC Life and Ergo to more than 50%.
All right, Surbhi, thanks a lot for that entire list of names. We're going to watch for all of these in today's session. Finally, let me hand it over to Mangalam, who's looking at all of the cues from the futures and options space. Hi, Mangalam.
Good morning. So if you just take a look at the data of the last 3 trading sessions, the close on the Nifty was just about 5 points away from each other. April 19th around 17,619, April 21st virtually unchanged at 17,624. Similar was the case with the highs and the lows on the Nifty. If you just take a look at the highs on the Nifty, there was some supply as soon as the Nifty crossed that 17,660 odd mark. So the highs were contained around that 17,660 to 17,680. And the lows, however, the Nifty found a support around that 17,550 to 17,580 odd mark as well. But now the SGX Nifty is indicating a positive start, and today this range could perhaps break out on account of 2 factors. One, both Reliance and ICICI Bank will react to earnings. Reliance has over 10% weight on the index, and ICICI Bank has around 8%, so 18% of the index reacting favorably to numbers. And secondly, it is also the April series expiry week that begins, so we'll keep an eye out on how that pans out. Ahead of that, the FIIs on Friday sold about 2,000 crores in cash. The DIIs bought around 1,600 odd crores. But FIIs in index futures, they continue to buy, and their longs inched slightly higher to 39%, with shorts at around 61%. But ahead of expiry, we are seeing FIIs buy more calls and at the same time sell more calls as well. So they are hoping for a bit of an upside, but that upside should be capped at higher levels is what they're playing for. 17,700 call saw a fair bit of writing at a premium of 54 rupees. Telling you once again, levels upwards of 17,750 may face some resistance. However, if it crosses past that 17,800 mark, there have been a lot of people who've bought the 17,900 call as well. 17,600 put, however, on the lower level has seen a fair amount of writing, telling you there is support at the 200-day moving average of the Nifty, which is 17,605. And on the way up, the 100-day moving average may be a bit of a resistance. So that's the band that we're looking at.
All right, Mangalam, we're going to track all of this. Thanks a lot for taking us through all of those cues from the futures and options space as well. But with that, it is time for our first short break on the show. When we come back, like we told you, Reliance Industries and ICICI Bank. Welcome back. You're still tuned into Power Breakfast. And as promised, let's talk about the big earnings that came through over the weekend and on Friday after market hours. First up, we had Reliance, which posted a strong set of fourth quarter earnings. Sonia is here with the highlights. Sonia, pretty much an all-round beat.
Oh, absolutely. The numbers were a beat on all parameters. In fact, most brokerages have given the numbers a thumbs up. So let me quickly just run you through the earnings. The beat really came in from the oil to chemicals business, which was very strong, and that led to a consolidated profit growth of 22% for Reliance Industries. In fact, the EBITDA margins on a consolidated basis also improved to 18% versus 16.2%. But as I said, the oil to chemicals business was pretty much the star of the show this quarter around. The revenues came in lower than what we saw last quarter, but it was the operational performance which really delivered this time. A 17% sequential growth in the EBITDA is what we saw for the oil to chemical business, and the margins have improved substantially to 12.7% versus 9.6% last quarter. Jio also reported a steady performance, and the retail performance was also on the stronger side. The average revenue per user came in at 178.8 rupees, which is a growth of around 6.7% on a year-on-year basis. A lot of brokerages have been very bullish on the stock. In fact, let me put a couple of them in front of you. Morgan Stanley says the company beat street estimates, and the energy vertical is what drove the Q4 EBITDA this time. Kotak Institutional Equities reiterates a buy. They have a revised target price of 2,800 on Reliance Industries. They say that it remains their preferred pick, and it's the energy vertical that drove the numbers this time around. And Jefferies has upgraded the FY24 and 25 EBITDA by 3%. They have a buy with a target price of 3,125. They say that apart from the energy vertical, it's the scorching pace of addition of the retail stores, which is something that is driving the earnings upgrade for them. Back to you.
All right, so very strong set coming through from Reliance. Sonia, thanks a lot for taking us through the fine print. But the other big numbers came through from ICICI Bank. Again, a very strong set of fourth quarter earnings. So Abhishek is here with the highlights. Abhishek, you said records galore at ICICI Bank. So take us through the numbers.
Well, Sandeep Bakshi has created history for ICICI Bank in terms of the records that have gallored and continue to gallop on many parameters. So, as I mentioned, the records have galloped. The net interest margin is at all-time high of 4.9%. The domestic net interest margin has crossed 5% for the first time ever. The international net interest margin is at 26-quarter high, crossing the 1% level. And the NII growth on the back of strong net interest margin momentum is one of the best that you are seeing in last 8 years or even more, up about 40.2% on a YOY basis. This has helped the PAT or the bottom line of the bank being the highest ever on a quarterly basis. So operating profit growth is also one of the best in last 18 quarters, coming in at 34.3% growth on a YOY basis. Highest ever quarterly profit has meant that the return ratios are the best ever or the highest ever that the bank has recorded, with ROA of 2.39% and ROE of 18.9%. The watch list is one of the lowest in last many years, coming in at just 0.46% of the book. Asset quality, both the gross NPA and net NPA are one of the lowest that you are seeing in 8 years or even more, perhaps 33-quarter low or even more. So unsecured book continues to rise. They are at 22-quarter high in terms of percentage of the book. Now they form about 19.4% of the total book. So this has actually helped the net interest margin as well, given the fact that it's a high-yielding book. On the flip side, the deposit momentum is on the lower side, growing at just 11% or less than 11% on a YOY basis. Going ahead, as management has indicated, the net interest margin may decline, but don't take it away, given the fact that 4% plus net interest margin is healthy. So in terms of NII and PAT, it's a beat on our poll. Back to you.
All right, Abhishek, sounds like an extremely solid set. Thanks a lot for getting us all of those numbers. But sticking with the banking space, we also had Reserve Bank of India, which offered HDFC Bank relief on priority sector lending norms and has permitted the merged HDFC entity to hike stake in both HDFC Ergo as well as HDFC Life to over 50%. This is before the effective date of the merger. So we have Ritu Singh with all of the details on this one. Ritu.
Well, there's some regulatory relief and some disappointments, if you could call it that, with RBI granting certain exemptions to HDFC and HDFC Bank for their mega $40 billion merger. First, the relief. RBI has allowed the bank to meet priority sector requirements in a staggered fashion in the next 3-year time frame. PSL is essentially loans to weaker segments of the economy, and banks have to keep 40% of their loans for this. So the merged entity is going to have some time to rebalance its book. The second relief is in terms of HDFC Limited stake in the insurance subsidiaries, where RBI has said that HDFC Bank or HDFC Limited can increase its shareholding to more than 50% in both HDFC Life and HDFC Ergo before the effective date. Currently, HDFC holds about 48 to 49% stake in both, where it will now hike stake marginally. Now, as far as HDFC's stake in other subsidiaries is concerned, so HDFC Education and Development Services and HDFC Credila, that will have to be brought down to 10% in the next 2 years. Now, where RBI has not granted relief is in meeting LCR, CRR and SLR requirements, which I'll explain. So HDFC Bank had sought a phased approach to meet these reserve liquidity requirement ratios. For instance, banks have to invest 18% of their deposits in government bonds, which is your SLR or statutory liquidity ratio, and keep 4.5% of deposits as liquid cash, which is your CRR or cash reserve ratio. But RBI has granted no relief on this front, and on the effective date, the bank will have to comply with all of these. Our sources, however, indicate that the bank may be comfortable enough to be able to meet these requirements by the time of the merger. Besides this, RBI has permitted the merged entity to link HDFC loans to appropriate benchmarks in a 6-month time frame, but it has also asked them to ensure that income recognition asset classification norms are complied with as on the date of the effective merger.
All right, so that is on Reserve Bank and what they have to say on HDFC Bank before the merger. So, Ritu, thanks a lot for bringing us all of the details. But with that, we do need to get into a short break now. When we come back, we're going to shift focus from all of this equity market action and tell you what's going on in the world of commodities. Welcome back. You're still tuned into Power Breakfast. We've gone through all of the equity market action. So let's see what's going on in the world of commodities as well. We have Manisha joining us for exactly that. Manisha, good morning. What are you tracking today?
Morning, Pavitra. I'm looking at the crude oil prices, which are trading at a 5-week lows right now. We have seen a 5% of decline in the previous week. The U.S. has added the oil and rigs for the first time in 4 weeks, so there is more supplies coming in there. And then the further rate hikes are expected to hurt the global energy demand growth going forward. What the street will watch out for this week, among all of the other data, is the first quarter GDP numbers that come in from U.S. Some pressure is seen continuing for the metal prices also. So you have gold prices, which have come off its 13-month highs. We have steel, which is now trading at a 4-month highs. There is uneven demand in China infrastructure and construction. Actually, the China steel demand from construction has declined 19% in the first quarter, and that's weighing on. But that's the case with the other metals also. Copper prices fell 2% previous week. We saw aluminum decline by 3%. And we've started Asia start on a weaker note yet again for many of these metal prices. So more red than green as I see it in commodities.
All right, more red than green. Manisha, thanks a lot for getting us that action from the world of commodities. But with that, we're out of time on this edition of Power Breakfast. We leave you with the news that the Asian markets are pretty mixed. There's really no big direction coming through. The SGX Nifty, however, is 55 points in the green. So thanks for tuning in. We have Bazaar Morning Call up in 2.